welcome back to the podcast, Ramp Up to Retirement with your host, Dan Reese. Dan, we are in the middle of a really fantastic episode series on terms of selling your business, what you need to know, how you need to prepare for it. And it's a multi-part series. If you, as a listener, have just joined us in the middle of this, fear not, go nowhere. You can listen to this episode and then go catch up with the others if you're so inclined. Today, we're talking about that really important question. What is your business actually worth? Dan, hello. And I'm tempted to say my business is worth exactly what I tell you it's worth, but I suppose that's not the right answer, right?
Yeah, no, it's super important because, if you have listened to the prior episodes, you hear one of the things we talk about. Most business owners, like typically anywhere from 70 to 90% of their net worth is tied up in their business. So I would say this is pretty important, right, to understand what it's worth.
That's implied. There's an implied thing there in that statement because there is what it's actually worth and there is what it's emotionally worth. Because if I've got 80 to 90% of myself tied up in a particular thing, I'm probably going to have a lot of emotion that's interfering with actual valuation. I'm guessing.
Yeah, I mean, that's a huge issue because the thing is, and I'm going to kind of equate this to a house. Like you'll hear, let's say you've got a house on a lake and it's, in people know lake property's valuable, right? And so let's say 4 years ago, your neighbor sold their house for X number of dollars. Say they sold it for $1.2 million and you're like, oh, our house is pretty similar to that. We will emotionally anchor to that. And all of a sudden your house is worth that, right? Because you've seen that and you're just like, now you may have never had an appraisal or recent one or not understood that the markets have changed. Maybe markets went from being very like people were really buying homes, interest rates were low, a lot of things.
Yeah.
And now they're not, all kinds of things. Well, that same thing applies to a business, right? Number one, we have an emotional attachment to our business. So we all like to think it's very valuable because it is to us and we build it and it was, it's like, hey, this is my blood, sweat, and tears. This is worth a lot. The other thing that happens, we get anchored. So we may have at one time had some type of valuation and somebody gave us some number and we're like, oh, I'm good. So when I want to sell it, that's what it's worth. I'm good. That's plenty of money, right? And then the other thing is like misunderstanding how business value is truly calculated, which we're going to get into that today. And, one of those favorite terms you've probably heard, some don't hear it very often, but EBITDA.
I love that term.
And it's an accounting term, but it goes to basically what type of profit is your company truly producing, right?
Yeah.
And because, as we know, value is driven around profits, right? That's what people want.
Tell people who don't know the term EBITDA, what EBITDA stands for, why it's important in terms of the valuation.
There's basically, it's earnings before...
it's earning before depreciation, interest, and taxes, basically.
Yeah, depreciation, taxes, those types of things. So what happens is that, especially in family-owned businesses, they actually even have to massage it a little bit more because so many times in a family business, there's a lot of other expenses that get tied in that really aren't true expenses, but we do it for tax planning as much as anything. Like maybe you're paying your kids some income that they really aren't really working there, or you are, paying for cars or things that really wouldn't count. So when you get into EBITDA, when you're talking about a family-owned business, oftentimes it takes a little more massaging to get it to the true number, right? And there's different terms for that, but when they're talking about somebody evaluating your business, right? But it's really important to understand because one of the things that happens, like I've got friends in real estate, right? And one of the things that's great about real estate, you can get a lot of benefits that are what we would call non-cash expenses, right? So like depreciation, right? So I've got these rental properties and I have this, it's pretty basic. These are the rents I get. These are the expenses for that property. And so if you look at true cash flow, that's kind of what you'd have, right? Like I got this much in, I had to pay insurance, taxes, some maintenance.
Mm-hmm.
Those types of things are real expenses that I have to write checks for. But then I get this other one called depreciation, which is kind of cool because it lowers, my profit and which it hence lowers my taxes, right?
Right.
But the truth is you actually received more money than that when you just factor in the actual things you had to write checks for. So that's a really important concept. And that's kind of what EBITDA starts to try to address.
I know EBITDA because I used to cover business and financial news, and I looked at corporations and companies. Well, like for example, a cable company which had a high capital cost. EBITDA was really important. Startup companies, EBITDA is really important. So that a lot of family businesses, right to your point, Dan, probably don't even think in those terms. They don't. But they may not even be familiar with the term itself. They're certainly familiar with the math, though, that comes with it.
Yeah, and I think that's really important because you think about it, there's kind of a there's kind of a conflict here, if you will. You're trying to build business value, which, we're talking about today a little bit, what your business is worth and maybe how to improve it. But you've got this, like, you're also trying to keep your taxes low as a business owner. And so when you look at your profit and loss and you're like, you try to throw things in there that can help reduce what you owe in taxes. But if you're like kind of looking at it from the outside looking in, that's a negative, right? In a way, because and that's why you need to adjust these things because you need to get it to a valuation or an EBITDA number where if you didn't have all these extra benefits, what would a buyer actually be receiving, right? And so it's an interesting area. And so you've got it, but you do have a conflict that comes up between, as running a company versus preparing to sell it.
And a couple of other things that factor in here, and one of them I know is like, what is your customer base? Do you have 50 customers, or do you have 50 customers and one of them counts for 40% of your revenue, kind of thing?
And understanding this stuff is super important because I want you to always think. So we're talking about what's my business worth, right? So keep in mind, it's kind of like, what is my home worth? And I use that because a lot of people can understand that easily. Well, what it's really worth is what someone's willing to pay for it, right? And I mean, that sounds very simplistic, but if you put your home on the market, and depending on if it's a normal market cycle, you're going to get people interested at the price you post it for. Some people may even bid more for it, and some people may less. I mean, there's a lot to that, right? Well, what you have to understand about a business is what is someone willing to pay for it? And so things that can change that, which when you talk about valuating a business, the lower the risk, the higher the sales cost, right? So we'll get into some of these things. And so when you think about that, I'll give a good example. Let's say you're an outstanding plumber and you do most of the work and you have great relationships with clients. They love you. You show up on time. You do a great job. Your price is reasonable. You may think, man, I've got a really valuable business. But the truth is, are you replaceable? So if you think about, hey, if Bob's gone and he's the one that does all this, that is the business, right? So someone walking in might say, that's not very valuable. Now let's take a different example. Let's take an example where there's a manufacturing firm and you're the president and owner, but you've built it out where you can be gone for a month and your business still runs like clockwork, right? So like you start looking at valuation, that's one of the things that a buyer would find very attractive, meaning the value would go up because the risk is lower. It's not all about you, right? And so when you think about that, that's one example. But customer concentration, same concept. Let's say we had an issue. I live in Michigan back in 2008, which I know seems like forever ago, but we all know the big three had that issue with the big financial downturn, right? There were several companies in Michigan that their customer was GM or Ford or Chrysler, smaller manufacturers that provided product for them. How do you think their business went when that happened?
Went south.
Pretty poorly, because they had no diversification in their clients, right? So that customer concentration is a risk factor. So the more, like as you spread out your customer base, it gets better for people that are wanting to buy it because that risk gets reduced. And there's other issues with customer concentration. Like I'll give you a simple one. I had a friend that had a manufacturing firm and they did a lot of work for a big company. They did work for others too, but this big company kept putting price pressure on them. We want it cheaper. We want it cheaper,
Oh, sure.
And he realized, luckily, this is not going the right way. So he diversified and said, we're not doing this. We're going to spread out and we're not going to keep getting into this because you can see where it's heading. So now his company is worth more because they're not so dependent on that customer that can put pressure on them.
And that implies another thing, I think, which is margins.
Yes.
And people, when they look at your business, are going to look at your margins. And if they see a customer who's been squeezing and the margins are getting smaller and smaller and smaller in terms of profit and doing business with them, to your point, that's not really attractive.
No, it's not at all. And the thing you got to remember is that there is nothing you are going to hide when somebody's going to buy your business.
Right.
Like, it's very difficult. I mean, people that are going to spend that amount of money are going to get into the books and they are going to question you hard on a lot of these things and say, hey, what's going on? Why is this revenue number going down from this client? And even though the number of units hasn't, those types of things. And so, and that goes back to, so the other thing about this whole valuation is really leadership depth. So we're talking about customers, we're talking about good margins where your customers are producing good profit, but, going back to eliminating, the reliance on specific people in your company, the better management depth you have also provides creates lower risk for a buyer. So if you just have a couple of key employees that run the whole thing, that know everything, those people are great when you own a company because it really helps you be successful. But think about if you were going to buy that company and you're playing devil's advocate, right? You're saying, whoa, what if Jill left and Jill knows everything about this area and there's no backup for Jill, right? You might, as a buyer, be like, wait a minute, this is a huge risk factor that's going to scare me a little bit regarding how much I might pay for that company.
What are some other things that buyers are afraid of? This is great stuff. What are some other things that the buyers are going to look at and it's going to give them pause?
Yeah. And this kind of goes right in line with these areas. So you think about, they hate key person dependency because they don't want to buy a business that all of a sudden vanishes because a key person left, right? That's a huge, huge problem. They're always concerned with supplier reliance, right? So like, who do you associate your business with that provides the goods to you, right? And understanding, what does that relationship look like? We had a situation, this is years ago, and I would talk about a learning experience. When I got out of college, there was this place in Jackson called Furman's Clothing Store. Awesome place. I mean, I'm telling you, everybody went there because we don't have a lot of department stores. And so you'd get your suits, when people wore suits and ties and all those things. But, and he had these typical contracts with like Hart Schafter and Marks and all these, nice clothing companies, right? That he would get his supplies from.
Oh, sure.
Well, what happened was the guy that owned it, Mr. Furman, had decided it was time for him to retire. And what they basically found is that those relationships he had weren't really transferable to a new buyer.
Oh,
easily anyway. So what ended up happening is they closed shop because, you look at his suppliers, but that wasn't easy to maintain for a new owner. They didn't know the new owner and they had very specific guidelines for, places they worked with and who they supplied goods to. And so, those are things a lot of people don't even really think about, when they're talking about this stuff.
And that's fascinating because, I mean, honestly, I would have thought some relationships, if not all relationships, were somewhat transferable, and it would never occur to me.
Yeah, it's interesting. Yeah. The other thing that comes up a lot is regulatory exposure. So depending on what type of business you have, is there anything out there that could carry over to the new buyer that could, environmental risk? Maybe you've got a building that maybe had some issues, many firms, like we're in Michigan, again, a lot of manufacturing firms.
Yeah.
Many of those had some soil contamination through the years. That stuff really wasn't even monitored. They had cement floors, stuff would go through the floors. They're porous. They'd end up in the soil. And you have all these areas now you start seeing where they're having to clean them up, which takes years.
Oh, I know. I live in New Jersey where we have more than our fair share of EPA Superfund sites, as a matter of fact. Yes.
Yeah, it's interesting. And then a couple other things that, and again, think of if you're buying a business, What you like to see is very consistent revenue.
Of course.
If you see a lot of variability in revenue, that's a red flag, right? Why is it all over the place? Right? And you think about, I think we're all used to seeing this now. What's every business trying to do now for the most part? They're trying to create subscriptions.
Yes.
Why are they trying to do that?
You can project that.
Yep. And
Yeah.
look at when Netflix profits come out, like did they have subscriber growth or not? Or you know what I mean? And what's how that look like? Because it's in the other thing is if you look at the most valuable businesses today that a lot of like venture capital are going after, places like insurance agencies that have, you know what I mean? They have reoccurring revenue every year. They build a book of business. Places like some professional practices like dentist offices, if they're transferable, it's very consistent cash flow. And so those are things that are super important. Then the last thing that really can scare people off are weak systems. And so with all the technology today, if you're buying a company, most buyers expect that you will have decent systems in place that are repeatable, that you can track processes and all those things.
No, that makes sense. There's a question that comes up here in my mind. And when you said weak systems, I thought of, simple systems, right? But also I thought in terms of finance, because I've heard accountants say, "Hey, it's great. You should audit your business once a year. You should have an audit available just for good practice." And they also say, "But it's not a bad idea to do informal audits during the course of the year, just so that you're on track, and so that if somebody comes in to look at your business, you can say, 'Yeah, no, I know we're on track, and this is how.'" Do you share that feeling?
That's a great point. So I'll use a simple example. I've run a business for years. I have been on, my business is not super complicated. We have a limited number of employees. It's just not, we don't have inventory. So, there's a lot of things that we don't have to deal with. It's a little easier.
Right.
But I've been on QuickBooks since like 2008. And I will tell you the ability to go back and look year over year over year to trends and different things and to be able to measure how we're doing is so valuable, and that's exactly what you're talking about. And the more complicated your business is, the more important that is, because, the thing is, like, if you have inventory, if you have multiple employees, if you've got healthcare you're paying for all kinds of people, all these different things, you've got suppliers you're buying stuff from, being able to go back and be able to consistently track that through good systems allows you to, number one, show that you're running a legitimate business to a buyer. Look, we have all these numbers. We've got nothing to hide. Let's say you didn't do that stuff and you didn't have good tracking of all those things to be able to compare. If you've got somebody coming in to buy your business and they start asking you those questions and you start giving them vague answers like, "Well, yeah, I mean, I think our revenue's been increasing," all these things, they're going to be like, "Whoa, huge red flag."
All right. So let's shift gears here for a second. Okay. Let's go from the scary stuff to the good stuff, because things you can control, in other words.
Yeah.
What should owners be doing when they've got their business, and how often should they be doing it?
Yeah. One of the great things that's happened, because there are so many small businesses across our country, there are these niche companies that have come out that basically will come in and, number one, and they're going to help you do a lot of these things we talk about. But I just want to bring it up so there's options for this, right? They will come in, they will evaluate where you are today, and then they will put together game plans with you on doing steady improvement in areas to deal with these things to make your company more and more valuable. And we call it value acceleration. And there's a process to it, right? Where we start with immediate needs and work our way up and to continually make your company more and more valuable. And so that's one thing I like to bring up, because a lot of people question, "Well, yeah, this all sounds great. I don't even know where to start." I'm like,
No. Yeah.
and so that there are companies that do a great job. And one of the things that I found is I started investigating some of these companies and talking with them. They actually are pretty reasonably priced. It might be like adding a part-time employee, and all of a sudden you've got experts in this area coming in. doing wonderful work with you, helping you know what to do so you can really accelerate that improvement. But let's jump into some of the things that they would tend to help you work through.
Great. Let's do that.
And so first thing is like building your leadership bench. And what's that mean? What that means is instead of having a few people that know everything and can do everything and not many others, it's beginning to develop people, develop others to understand those roles, understand what they do. This is just good business. I mean, period. Because here's the thing, you may love those people, but all kinds of things can happen. They might get offered a great job somewhere else. We're like, hey, I really like you, Bill, but I can't pass this up, right? They may have a health issue. They could pass away. There's all kinds of things that could happen, right? And so you have to understand as you're looking through these things is that the anything can happen, right? And you lose that person. So good businesses developing that bench of people that can step in, can do some of those duties, maybe when they're gone on vacation even, and make your company more valuable.
Makes sense.
Yeah. And the next thing is really, which everybody hates this, it's funny, standing operating procedures. Like I hate standing operating procedures because they sound like a lot of work and no one's going to follow them.
Yeah, but this goes to your point earlier about weak systems. If you've got some SOPs, then you tend to not have weak systems, right?
100%. And so these standard operating procedures builds credibility. It actually reduces errors. I mean, you look at like back when hospitals, years ago, I know you remember this, Bill, like some of these major lawsuits, all this stuff was happening with hospitals, like in surgery situations, infections, all these things. So what did they go to? This guy said, hey, you know what airlines do? Airlines have checklists. So every time a pilot's getting ready to fly, they go through it, even though they've flown that plane hundreds of times, maybe thousands of times. Because guess what? There's a little known fact. The more comfortable you get doing something, the more likely you are to actually miss a step in what you're doing. And so that's something that standard operating procedures helps with quality. Quality reduces risk. Quality increases value of your company. And so standard operating procedures, and today with all the technology, you can really expedite that with AI and all these things to help you build that stuff. And so really, there's no reason not to be doing it. And it's a huge value add.
I love that example, by the way. That's a great analogy because I know a couple of pilots and I know a couple of commercial pilots. And yeah, they get in that cockpit. They've done it hundreds and hundreds of times, but they're not taking that plane off the ground until they've gone through that entire checklist every single time.
Yep.
Because it just ensures everything is going to go that much more smoothly.
100%. There's no question. Couple other things we talked about: diversify your customers. Make sure you're not getting pinched. Make sure that you've got a good, and that might be an area where, a value acceleration expert might say, hey, we need to increase your marketing a little bit in your sales area because you might get comfortable because your business really is running well because you've got really good customers. But when you dive deep into it, you might be like, we gotta expand this a bit, right? Make it better. We mentioned quality reporting. You got to be able to show people what you're doing. Telling people's fine and somebody's going to give you money for something, you got to show them, not just tell them. Let's be Missouri.
Absolutely. Yes.
Right. And then the final one that a lot of people don't think about, because I think as you're building, so I see this pretty frequently with family-owned businesses. They tend to, number one, they do tend to take care of their people. That's one great thing about family-owned businesses. They tend to be pretty good, flexible, caring. It's not as rigid as big companies, but a lot of them don't do as good of a job of aligning compensation with incentives. And so what I'm getting at is that keep in mind, let's go back to EBITDA. We're trying to improve our EBITDA, And so if we get everybody tied in to that, everybody in the company are like, look, we're going to bonus based on hitting these numbers. Guess what happens? You will be shocked. You hear stories. Like I heard a story of, it was like an auto parts store or something. There were like just a rank and file employee out in the parking lot, and they saw it was like a bolt, something that could pop a tire, and like, so they're like picking this stuff up because they don't want any customers to pull into their parking lot and like, have a flat tire and then be angry and all these other things. And you see crazy things that people do when they understand it. The other thing is even purchasing decisions. You might have people say, "Oh, you know what? We don't really need that." Where if they weren't tied into that, they'd be like, "That'd be nice to have." If you're like buying new equipment or whatever it might be.
Yeah.
And so that aligning incentives can be a huge way to really improve your enterprise value.
That's fantastic. Well, Dan, we're coming to the end of this particular episode. So if you could give us a synopsis of the key points that you want people to walk away from this one with.
Yeah. Number one, understand that you probably don't really know what your business is worth. You might think you have an idea, and that's okay. But taking the next steps is really important. Like I mentioned, getting a true valuation can get you started. Like, what is it truly worth? Understanding you're probably going to be surprised. It could be good, it could be bad, right? But getting a baseline of where you are, and then working with one of these value acceleration providers to sit down with you, immediately identify some of your greatest risks and start working on them. And these are typically what they would call 90-day sprints and things like that when you talk about business planning. And so what that is that it's like 90 days. Let's put some priorities out there. Let's work on improving them. Let's circle back at the end of 90 days. Have we accomplished that? Do we need to continue to work on it? And for those that we've accomplished, let's start replacing them with new things for the next 90 days so that we can consistently improve our value, improve our company, right? And so that's a real thing. And then, really beginning that owner dependency reduction. A lot of us that have family or have like family owned businesses, it is super reliant on us. People like us. We built the business. Like, I don't know if they all like us. That might be a little presumptuous, but
Well, they're still with you. They obviously appreciate you if they don't downright like you.
right. And so, you have those relationships you've built. So really working to reduce that dependency a little bit. And then really just tracking that enterprise value ongoing annually. How are we doing? Because if you're doing the value acceleration correctly, your business should continually be becoming more valuable, right? And that's what you're trying to get at, because next thing you know, because this stuff's all super important because you want to take care of the business you built. But the reality is the part of the reason you're doing it not only is to have a better run business, but when it is time to exit, and sometimes you don't have a choice on that, it's worth as much as possible. You know what I mean? So like sometimes you're exiting on your own. Sometimes it's not something you can control. And so making sure it's as valuable as possible when that time comes is just so important.
Pay attention to your business while you do your business. I guess it's really the simple way to put that there. So, Dan, if anybody's listening to this, they may own a business and they're interested in at least having an initial conversation with you. What is the best way for them to get a hold of you and proceed with with just a talk?
Yeah. And I highly recommend reaching out and having a discussion if you own a business, because number one, as a certified financial planner, oftentimes I act as kind of the quarterback for clients and aligning them with other providers and other professionals that can help them through this journey, right? It's very, very important because it can be overwhelming. I mean, you're already running a business, you have family life, you've got a lot going on, right? So it's really important. But the best thing to do is just check out our website, averywealth.com. We've got a lot of business owner resources out there that you can like start to get more educated on, which I think is a great thing, because really all this stuff's about expanding your knowledge in this area, and in understanding like there's a lot to it. Don't be, don't get scared away, because it's going to help you as you learn and as you start talking to people about it. And the next thing is just there's a contact us page on our site. Just click on that and I'll reach out. We'll schedule a few minutes to talk, just kind of see where you're at. And I can give you direction. You know what I mean? I can give you like a next steps that would make sense. And as you listen to this series, you'll know there's a lot to this. There's personal planning, there's personal financial planning, business planning, a lot of different parts that go into it. So, starting the conversation so you can begin to put together a game plan is really the best thing you can do.
Yeah, and I just want to underline this for people who are listening who maybe don't know Dan. The initial conversation is free. It doesn't make you committed to doing the rest of your life with Dan. You may in fact talk to him and think, you know what? I do want to have a relationship because I'm not sure where I am and I'm not sure what I'm doing. And this sounds like a relationship I want to have. You may also decide, that's good to know. I'm not ready for this talk yet. But it costs you nothing to reach out and at least have that initial contact with Dan. So I'd encourage you to do that.
Yeah. And I would just say too, it's funny when you talk about, like, I know in the world we live in today, people can feel pressure about different things. Like, I was telling a client this the other day, and I'd worked with him a long time, and he was just like kind of saying how much he's appreciated our relationship over the years. And he said, one of the things I always liked is you never, ever put any pressure or anything on me to make any decisions. And I told him this funny, quick story. When I was considering getting into this field, I took a personality test with one of the big places. And they came back and said, "Hey, I hate to break it to you, but you're going to suck at sales." So I'm like, "Oh, okay."
Well, thanks. I appreciate that.
So I got that going for me.
Exactly. No, the other thing you can do that costs you just nothing at all is hit the follow button. If you're not already a subscriber, hit that follow button and you will automatically be subscribed. You won't miss another episode. You will be informed the next time the next part of this series is released by Dan, as a matter of fact. And you can go back and on his website, you will find the other parts of this series that you can give a listen to and get caught up on. Lots of information in there, and I would encourage you to do that. The other thing I would ask is if you find this information useful, if you find it interesting, give it a like. Word of mouth promotion is so much more important today than it ever was because we're so used to so many things not being human. A little human touch to everything is much appreciated along with word of mouth. And we thank you for that in advance. So until next time, I'm Bill Tucker on behalf of Avery Wealth and Dan and everybody at the business. Thanks for taking the time to listen today, and we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.